What if I told you that the real force driving gold prices higher isn't fast interest rate decisions or market speculation, but a silent yet determined power? And this force could ignite a historic move in the gold market in the coming months. Welcome to Heartofeconomy. Today we're going behind the scenes to discuss the most important factor shaping the future of gold prices, a factor most investors overlook: central bank gold purchases. This is not just a short-term price move, it is part of a major shift in the global monetary system. Stay with us until the end, because by the time you finish this video, you'll have a much clearer picture of why gold has entered a new era, not only in terms of price, but also in strategic value. How has the role of central banks changed? A historic paradigm shift is underway in the gold market. In the past, central banks viewed their gold reserves almost like a burden. Throughout the 1980s and 1990s, many central banks sold their reserves, saying gold is an asset of the old world, it has no place in a modern financial system. In fact, the UK's massive gold sales between 1999 and 2022 went down in history as bronze bottom because they occurred when gold prices were at their lowest. But after the 2008 global financial crisis, the picture slowly began to change. The fragility of the financial system reminded central banks that they needed a safety cushion beyond paper currency reserves. Still, the real turning point came in 2013. From that year on, central banks become net buyers. In other words, they started buying more gold than they sold. Then, in 2022, following the Russia-Ukraine war, the trend exploded. When the West froze Russia's foreign reserves, many countries realized something important. Your dollars, euros, or yen can become worthless overnight due to a political decision. For central banks outside the US, this represented a massive security risk. The solution? An asset with no counterparty risk, one you can hold physically, and that is universally accepted: gold. The scale and impact of these purchases. The numbers behind this shift are striking. According to World Gold Council in 2022, central banks bought over 1,100 tons of gold, the highest annual purchase since 1967. And it wasn't just a one-off event. In 2023, purchases again exceeded 1,000 tons. In 2024, the pace has slowed somewhat, but still remains well above historical averages. The impact of these purchases on gold prices is deeper than many expect. That's because a large portion of gold trading involves what's called paper gold, futures contracts, and ETFs. Physical gold, on the other hand, is limited. When a central bank buys physical gold, it is taken out of the market and doesn't return for years, creating a lasting supply squeeze. Another critical point is that these purchases are price insensitive. A regular investor might pull back when gold prices rise too high, but central banks focus not on price levels, but on long-term security and diversification goals. This creates a buyer's wall whenever prices fall. The delayed entry of Western investors. One of the most interesting aspects of this bull market is that Western investors have not yet fully joined in. Normally, when gold prices start climbing, funds, ETFs, and major portfolio managers in the US and Europe rush to buy aggressively. This time, that hasn't happened. Why? Because Western investors typically base their early-stage gold bull market decisions on interest rates, inflation, and the dollar's performance. Over the past 18 months, high interest rates have made bond yields attractive, limiting inflows into gold ETFs. However, as central bank buying continues to push prices higher, Western investors' sentiment is starting to shift. The mindset is changing from "it's gone up too much, I'm late" to "it's going higher, I don't want to miss out." When this psychological shift begins, the first movers are usually the major gold mining indices, GDX, GDXJ. Then, interest often surges toward riskier but higher potential junior mining companies. As seen in past bull markets, the second wave can send prices moving much faster and higher. Fed policy, debt problems, and gold. There is one fact about the US economy that directly affects gold's long-term outlook: federal debt. As of 2025, the US's total debt is nearing $35 trillion. When interest rates remain high, the cost of servicing this debt, the annual interest bill, rises rapidly. This is unsustainable, meaning that in the long run, the Fed will have no choice but to keep rates low. But if rates remain low while inflation stays above target, we enter a negative real interest rate environment. This is one of the most favorable conditions for gold, since gold doesn't generate interest. When rates are near zero, the opportunity cost of holding gold drops significantly. Therefore, the US debt problem and the Fed's inevitable shift to low interest rates create a structural foundation that will support gold in the years ahead. Silver and related spillover effects. Central banks buy gold, not silver. The reason is simple: silver is not considered a reserve asset by central banks. However, when gold prices rise, silver usually follows, often with a lag. Recently, silver's break above the $35 level was significant because it was a technical barrier it hadn't overcome in many years. It recently approached $40 before pulling back slightly. Still, as long as silver stays above $35, the trend remains upward. If gold prices climb above $3,500 due to central bank buying, silver's previous $50 peak could once again be on the table. Potential risks and alternative scenarios. No market moves in just one direction. Central bank buying could slow, especially if prices rise too quickly, prompting some countries to delay purchases. Additionally, if the global economy recovers faster than expected, investor demand for safe haven assets could decline. However, the key distinction here is that such developments may cause short-term corrections, but they won't disrupt the long-term trend. Central banks don't hold gold for short-term gains. They keep it as a strategic reserve. This means their buying will likely continue for years. What should individual investors do? Now that we've reviewed all this data, historical trends, and the strategic moves of central banks, let's answer the critical question: what should individual investors do? First, accept this truth: central banks don't buy gold for quick profits. For them, gold is insurance, protecting their portfolios from currency risk, political sanctions, and global economic shocks. And throughout history, this insurance has worked. For individual investors, the logic should be the same. Gold is like insurance for your home. You hope you never need it, but if you do, it can save you. So how should you insure yourself? Prioritize physical gold. Just like central banks, buy certified gold from trusted sources. Physical gold is not a claim on paper. It's a tangible asset in your possession. Allocate a portion of your portfolio. The percentage you dedicate to gold depends on your risk tolerance, but in times of global uncertainty, increasing that allocation can be wise. Be patient. Gold can fluctuate in the short term, but remember, central banks drive the long-term trend, so don't let daily news trigger panic. Diversify. Alongside physical gold, consider gold mining stocks, ETFs, or complementary assets like silver. My personal take: the next 3 to 5 years could be a period for the gold market that will be written into the history books. If central banks maintain this pace of buying and the Fed moves into a low-rate environment, gold could not only set new records but also stay above them. Early entrants could benefit both from price appreciation and the preservation of their wealth. Now, think about it. The world's largest financial institutions, central banks, are reducing their holdings of dollars, euros, and yen to buy gold. This is no coincidence. It's a powerful message about the future. They know the global monetary system is fragile, that political decisions can wipe out reserves overnight, and that inflation can quietly erode wealth. And they are taking action. So what will you do? Will you wait and watch, or will you act now to protect your own financial security? History rewards those who act in time, not those who hesitate. At Heartofeconomy, we reveal these behind-the-scenes forces. The story is told by the numbers and the global trends shaping our future in the clearest way possible. If you want to follow this analysis, market insights, and strategic information in real time, subscribe now. Don't just be a viewer, be an informed investor. By subscribing, you'll get updates on the Fed's moves, central bank purchase data, the impact of geopolitical developments on gold prices, and opportunities in related markets like silver instantly. This way, you'll be on the leading edge of the market, not chasing it from behind. Remember, knowledge is power, and power belongs to those who take the right step at the right time. We're here to help you identify that right moment. Join the Heartofeconomy family because this journey is just beginning. And what's coming next will make its mark on financial history. Be part of that history on the winning side.